So no matter how much debt you have, it's super easy to feel overwhelmed by it. The good news is this: the word budget doesn't have to be a dirty word to you. So if you watch this video, what I'm going to do is I'm going to show you the simple steps you need to effectively manage your money to get out of debt super fast. I'm going to give you a real life example of a chiropractor that had $478,000 in debt and how he changed just one thing, and that was where his money went first. How he erased all of that debt in 6.5 years without working any harder, without working any longer, and without changing anything in his financial life. So if you are similar and you want to learn how to do exactly that, and you agree that you can change one thing and that's where your money goes first, well then I'm willing to show you exactly how you can pay off all your debts and how you can earn wealth and build wealth at the exact same time. So let's get started. So let's start with this. The first thing I want to get across is what we're going to learn. We're going to learn the money multiplier method, and there's 3 components to the money multiplier method. The first thing, we need a machine. That machine, all we're going to use it for is we're going to use it as a place to move our money through it. Think of any other machine. We're going to put something in the machine and out the other end is going to come something different, something complete. Well, that's all this is going to do. We need a machine that we're going to run our money through, a machine that's going to pay a higher interest rate than what the banks do, a machine that's going to allow your money to work for you even when your money's out working. And what does that mean? That means you get to earn uninterrupted compound interest. So that's all the machine's going to do. And we're going to cover that in a second. We have to understand that this is a marathon. Building wealth, well, unfortunately, you can't get rich quick. So building wealth is a marathon. And I need you to understand that what I'm going to show you, paying off debt, it's not going to happen overnight. But if you follow this system, the money multiplier method, you will be able to pay all your debts off, just like the chiropractor at the end that I'm going to show you. And not only that, we have to have a goal, okay? You can't work toward nothing. You have to set a solid goal. And that goal can be anything. I want to buy a new car. I want to buy a new house. I want to have an income of $3,000 a month. Or, for today's topic, I want to pay off all my debt in 6.5 years. Now, whatever your goal is, we need to solidify that, because without knowing the goal, the marathon and the machine don't make sense. So the next thing I want to do is I want to talk about the machine first, because this is going to be the one that's going to be like a left hook or a right hook right to your face. So this machine that we're going to use has been used by the wealthiest families in history. Who am I talking about? Well, the Rothschilds, the Rockefellers, the Morgans, the Stanleys, the Walt Disneys, the Ray Krocs, the Doris Christophers, the Bidens, the McCains, and the Warren Buffetts. All of them use this same thing. And you know who else? The banks. That's right, the traditional banks. So what is the machine that I was mentioning earlier where we're going to run our money through? The machine that's going to pay us a guaranteed interest rate plus dividends, allow our money to live and build in a tax-free environment, and also give us the ability to earn uninterrupted compound interest, which I'll cover later. That machine is right here. A dividend-paying whole life insurance policy from a mutually owned company. Now hold on, before you click stop on the video, hear me out. I'm not talking about a regular whole life insurance policy. And I'm certainly not talking about the whole life policy that your broke-ass brother-in-law tried to sell you during New Year's Eve. I'm talking about the same design and the same way whole life is used for the banks. And the same way whole life has been used by all those wealthy families. You see, it's not the whole life that you really need to be concerned with. It's how we design and engineer it so that it doesn't function just as a overpriced life insurance policy. We want it to function more like a bank. And we want it to have some of the characteristics of your bank account. And we can do that. Trust me. Well, if you don't believe me, well, then why don't we look at who the #1 purchaser of whole life insurance is in the world? And that is traditional banks. Look it up. Google BOLI. And what you'll find is that banks purchase more whole life than they do, or banks own more whole life than they do all the land and the buildings that they own. So if you're still hung up on the whole life, well, stay with me and I'm going to show you how this works. I'm going to show you what it looks like. I'm going to show you how we use it, because it's not the way you think. So there's essentially 3 rules we must follow for this to work for paying off debt. Rule number 1, we have to pay ourselves first. Remember what I said earlier, we got to change one thing, and that's where your money goes first. And it's going to go to that specially designed and engineered whole life insurance policy. That's the first stopping point. The next thing we need to do is when we pay ourselves back, we need to pay ourselves back with interest. If you're going to become the bank, you need to treat your money the same way you treat the bank's money. And there's never been a loan you've borrowed from the bank where you haven't paid them back with interest. The same thing here. When we borrow from your bank, the specially designed and engineered whole life, we're going to pay your bank back with interest. And number 3, which you'll see in just a second, we're going to focus on recycling and recapturing all of your money. So if doing that is where we start, this is what it looks like. So let me frame this up. This is a real person's situation. He was a chiropractor. He saw us speak at an event, and after the event, he pulled us aside and he said, "Hey, I've got a problem. I've got $478,000 in debt. 9 different debtors: Discover, Lowe's, Nordstrom, Wells Fargo, private loan, BMW loan, West Marine boat loan, condo, and a house loan. All of them totaled $478,774. But that was only the start of the problem. You see, all of that debt, if we were to add up his monthly payments, totaled $5,777 a month. That is $69,324 a year that this chiropractor was giving away to somebody else, and that was a huge problem. So the first thing we looked at and we asked him was, we said, how much money are you saving per year? So we added up all the money he saves between the 401k and his savings accounts, and it came up to be $25,000 a year. Not too bad. So he was saving money. Now, let me pause. This system, the money multiplier method, is only going to work for those that can save money. If you're not saving and you can't save, we need to figure that piece out first. But if you are saving and you're okay with changing one thing, and that's where your savings goes first, that's where we begin. This chiropractor was saving. So when we figured it out, we asked him a question. We said, well, what if we just took the amount you're saving, the 25 grand per year, and we just paid off all these debts using just the savings? And we did the math. It would have worked out to be 19 years. So it would have taken this chiropractor 19 years to pay all these debts off using the $25,000 a year. That was unacceptable. So we ran our numbers, the way you're going to see in just a second, and we said, Mr. Chiropractor, without you working any harder, without you working any longer, and without you changing anything in your financial life except for that one change, we can pay all this debt off in 6.5 years. And he said, show me how. So let's get into it. Here's how we did it. The first year, what we did is we changed where his deposit went. We put the $25,000 into a specially designed and engineered whole life insurance policy. And then immediately in the first 30 days of when his policy was funded and issued, we took a max loan of $14,863. So we took that $14,863 and we paid off Discover, okay? We paid off Lowe's. But then what we did is we saved the $161 and the $287, and we put that money into a segregated bank account. So every month, instead of giving Discover and Lowe's $161 and $287, what we did is we did a bill pay or a transfer to one of his bank accounts. But see, this bank account that we had this chiropractor set up was a new bank account, which is why we call it segregated bank account. So this money every month is now going to be put into a bank account that is set up for the sole purpose of this chiropractor's banking system, what I'm teaching you. So at the end of the year, once we'd paid these off, this chiropractor had paid his debts down, okay? So he now only owed $468,774, and his monthly payment due was only $5,329. That means $448 could go into that segregated bank account. Let's go to year 2. Because we're going to keep doing the same thing. Year 2, this chiropractor saves another $25,000 into that specially designed whole life. He immediately takes a loan from the policy for $16,571. We take that loan and we pay off Nordstrom, Wells Fargo, and the private loan that he used for his chiropractic practice. And in paying all those off, he no longer owed Nordstrom $276 a month. He didn't owe Wells Fargo $271 a month, and he didn't owe the private loan $922 a month. But what he did is he set up a transfer for those exact amounts to go to his segregated account. So all we're doing is we're putting money in, We're taking money out in the form of a loan, and we're paying off the debts. Now, some of you are probably saying, well, wait a second, we're taking loans from the insurance company? Yes, we are. And I'll explain that in just 1 second. But I want you to understand the fundamentals of what we're doing here, because it's quite simple. And you could do this, all of you could do this without the specially designed whole life, but it works better with it. So down here, because we paid off all those debts, we now have a debt of, I believe it's $398,060 some dollars. Sorry, my numbers are blurring. And the monthly payment he used to make was $53.29, but now all he owes is $3,860 a month to everybody else's bank. He is now saving $1,917. Now remember, that $1,917 a month that is going to the segregated account, it's not new money. It's all the money he gave away to all these debtors the previous 2 years. We just changed where the money went. We call it recycle and recapture the money. So he's taking that exact payment and putting it back in that segregated account. So over here, when we did this, the math worked out. He took a $25,000 deposit, put it in. He took a loan of $16,571 plus the payments, which was $5,376, was the amount he had saved in that segregated account. So he had 21 grand, which is how we paid all those off. Okay, let's go to the third year. In the third year, he puts $25,000 in the policy. Now this year is very important because this year he takes a loan for $25,541. I want you to really hone in on $541. You see, his money that he's been putting into that specially designed and engineered whole life has been earning a guaranteed interest rate, plus every year he's earned a dividend. So the interest plus the dividend has compounded uninterrupted. Even though he's putting money in and taking money out, the money he put in never leaves his account. The loan he's taking out is part of his death benefit being advanced to him by the insurance company up to the amount of cash value he has, because that's the collateral. So you see, his money never left his account. So his money never stopped earning interest. That's where the uninterrupted compound interest comes in, which is exactly why now in the third year, and it took him 3 years to get there. This is the marathon I talked about. In the third year, he's now able to take out more than what he put in. And there will never come a day in his life where he'll take out less money than what he puts in after this point. So the cash value is $25,541, plus he was saving $1,917 every month in that segregated account. So if we do that times 12, it's $23,004. So we had a total cash of $48,545, which we used to pay off the BMW loan and pay off his boat loan. So now the boat loan and the BMW loan are gone, which frees up $499 a month plus $1,261. Where's that money going to go, folks? That's right, back into his segregated account. So now let's do a quick recap here. This is the marathon I talked about earlier. So every year he put in $25,000. So 25 plus 25 plus 25. He put in $75,000 over 3 years. How much money did he take out? First year he took 14. Second year 16. Third year 25,000. These are all loans he took from the insurance company. How much money did he have left? So he put in 75 and he took out 55. How much would be left? 20,000? Some of you are doing the math and you say, well, he's got 20 grand left. Started with 75, took out 55, there's 20 left. Wrong. There's $75,000 left. I said that a second ago, but I just wanted to show it in the numbers. His money, his deposits, always earned interest and dividends, even though he took most of that money out to the tune of $55,000 in loans. How much is left in his policy? All of it. Uninterrupted compound interest. So let's go on and finish this thing up. Year 4, same thing. He puts in $25,000, has $26,304. So now he made $1,304 that year because of the compounding. So he takes a loan for $26,304 plus he was saving that $36.77 times 12 is $44,000. So he had $70,428 in both accounts. Takes that out and he pays the condo off. Okay, the condo is paid off and the house is paid down. So now in the 4th year, he has now paid down the condo and the house. So here we go. Year 5, we move on. He's got $25,000 he puts in, takes out $27,090, plus he's got $54,000 in the segregated account, which is basically the amount he paid off with all the other ones. So what he's going to do, he's going to take that $81,762 and he's going to pay off the condo, because he only paid the condo down the last time, and he's going to pay down his house. So now at this point, my numbers are all jumbled together, but that's because we're trying to do it on a big screen here. So at this point, his monthly payment every month is only $1,221. Remember, it was over $5,700 to start. Now he only owes his primary mortgage, $1,221, which means he's able to save $4,556 in that segregated account. He's doing pretty good in the 5th year. Now, the 6th year, he puts in $10,000 into that first policy because he can no longer put $25,000 in. Not going to get complicated with this, but there are IRS rules. So this client, the chiropractor, had maxed out his first policy. He no longer can put $25,000 in. The max he can put in is $10,000. So because he can put $10,000 in, that $10,000 allows him to take out $13,092. How much of a return is that on that $10,000 deposit? It's over 30% cash on cash, right? So he takes the $13,000, but at this point he's like, this is so good, I want to put more money away. So we start a second policy for him. So he puts $25,000 in a second policy, takes out $14,863, plus he had been saving that money, that $4,556 in that segregated account, so he had 69 grand there. So if we add up both cash values, the 13 plus the 14 plus the segregated account, he's got $97,588, of which he pays down his house of $76,000. He's got some extra money left in the bank, and he is debt-free in 6.5 years. Folks, I know the numbers there's a lot of them, and I know they were a bit jumbled, but all I want you to understand is we didn't change a whole lot. We just changed where his money went. In the first 3 years, he lost money, putting that money in that whole life. But every year after the 3rd year, he was making money. And you can see $10,000 got him $13,000. How many of you would love to go to your bank and put $10,000 in it? And then the bank allows you to take $13,000 out. And when you ask why, they simply tell you compound interest. Folks, this is how you can pay debt off, okay? It's called the money multiplier method, and you have to be able to recycle and recapture the money that you gave away. But if you do that, you will be able to pay off all your debts as well. Folks, I hope you enjoyed this video on how paying off debt can actually be fun and help you build wealth. But if you like this, you'll love this video right here. How to generate passive income with no initial funds. See you on the next one.